Hello and welcome to my course Monetary Policy in a New Era. I'm teaching this course this semester at the University of Neuchâtel, spring 2023. This is a recording that I'm recording prior to giving the first lecture, kind of to prepare myself to go through the materials and also just to upload it on YouTube for you guys out there who are interested in monetary policy making. So essentially it's just the first session recorded. It's more or less a freestyle thing that I'm doing here, but I'm pretty sure that you will learn something anyway. So let's jump right into it. This is the course Monetary Policy in the New Era. I'm a lecturer at the University of Neuchâtel. I'm also actually a lecturer at the University of Bern. I'm a journalist at Swissinfo mainly, where I write and where I also have a podcast called Geldcast. This is a German podcast about monetary policy. It has also some English videos on my YouTube channel. You can check that out if you like. I have another podcast which I'm doing with Alexandra Janssen. It's more of a discussion. We just like clash. Basically, she's more of a liberal and maybe more of a leftist, and we do discuss current economic issues. And then I write for various outlets, the Republik magazine, as you can see here. I'm a journalist at SRF as well. So I'm doing many things, including teaching at the University of Neuchâtel, which makes me very happy. So who cares about this course? That was kind of my starting point. I designed this course during my Ph.D. at the University of Bern when I realized we don't have really a course which covers current monetary policy making. We learned a lot about monetary policy making, but more on an abstract level. What I wanted to cover was more like an intuitive way of understanding how monetary policy works, and works means how it is transmitted to the real economy and how it is implemented on the money market, for example. And then I asked the students at the University of Bern, the bachelor students, would you take such a course? Because I didn't want to come up with a course who no one cared about. And well, I asked them this question: how well could you explain to a friend how a new monetary policy instrument like forward guidance is implemented in practice on a scale from 1 very poorly to 8 very well? And then we have the survey results, and the following graph presents the share of students who report that they are unable to explain this new monetary policy instruments. Unable would be like students who said 1 to 3 on a scale from 1 to 8. So with negative interest rate policies, I was pretty surprised. I did this survey, I think in 2018 or 19, and about 50% of the students said they know nothing about negative interest rate policies. And that was a year when the Swiss National Bank had negative interest rate policies. You can see that here on top. And we have different sample sizes because I conducted the survey in 2 different classes. With quantitative easing, it's a bit better. With forward guidance, which central banks heavily rely on, even today actually, like more than about 3/4 didn't know anything at all about forward guidance, and I found it kind of shocking, and that strengthened my belief that we should have such a course which covers these new instruments. With exchange rate floors, it's also about 50%, which is very special in Switzerland, given that we had an exchange rate floor from 2011 to 2015. So take-home message from this slide here is students in the bachelor's, they don't really know too much about current monetary policy instruments, and maybe we should teach them. The other interesting result for me, and an encouraging result, was that the students care about these instruments. They want to know more. 96% of the students said they want to learn more about quantitative easing. 98% wanted to know more about forward guidance. So apparently these students realized that these were instruments which are out there, which central banks use. They've heard of them apparently, and they want to find out what it is because they don't know anything about it. At least most of them don't know too much about it. Let me say here that I'm not saying that teaching at the university is bad or of limited quality. I liked it a lot being at the University of Bern. I did my bachelor's, my master's at the University of Bern. I found it great. They reflect the desirability of offering such an advanced course, of an intuitive course. That's my reading of the results. Student interest is pretty high. I asked them, would you come to such a course if the University of Bern were offering such a course? And 44% said very much I would come. 8 out of 8 or 7 out of 8, and that encouraged me further to work on that course. Well, as you can see, I'm not teaching it at the University of Bern at the moment. I'm teaching it in Neuchâtel, but I'm still very happy to teach it there. And what I would like to do with my students in class, when I'm in class, is I would like to start the opening session with a question, to get them awakened, kind of, to let them interact. That's one of my main goals in this course, to have it very intuitive, to have it very interactive, and I have to encourage them to talk to each other. And I would like to find out if they know of these 4 epic moments. I would call them epic moments in monetary policy making, and which of them they find most interesting. So we have 4 that I picked out. Christine Lagarde of the ECB, who said, we're not here to close spreads, caused mayhem on financial markets for about 4 hours until the ECB put out a statement in which Philip Lane, the chief economist, said, okay, maybe we're here to close spreads anyway. Then we have Ben Bernanke at the Fed, which in 2007 said subprime mortgages was one to seriously hurt the economy, which is strange to say the least, because in 2008 the subprime mortgages were kind of the starting point of the financial crisis, the global financial crisis. Then we have Philipp Hildebrand of the Swiss National Bank, who said the SNB toleriert ab sofort keinen Euro-Franken-Kurs unter 1,20 mehr. That was the introduction of the minimum exchange rate, which I found pretty epic too. I mean, he just like stepped in front of the media, said that, and immediately the course jumped up from, if I remember correctly, around 105 to 120. And then we have Mario Draghi, of course, who said, I believe, the most famous words in central banking ever: the ECB will do whatever it takes to preserve the euro. That was in summer 2012 in London, actually, at just a random talk he gave, not a press conference of the ECB. And he said these words, and he kind of ended the euro crisis with it. And actually he added, and believe me, it will be enough. It's an absolutely amazing communication thing that he pulled off there. But of course, with you guys at home, I cannot do this interaction here. I will just go over it and tell you what we will do in class after we talked about these 4 epic moments in monetary policy making, and then we'll jump into the topics. So we have the first block, an introduction, the course objectives, and the work in progress. Of course, I will tell the students what we cover in the course and what I'd like them to do during the semester. Then we have a second block, which is pretty big. This is instruments to think about monetary policy. I would like to give them 2 instruments which are very important for them to have in mind to kind of think about current monetary policy making. These are models in a sense, but very simple model, not too mathematical models, but very powerful models, I think. And I will teach them these models kind of from like just standing in front of them, telling them about these models, and then they have some workhorse models which they can just pull out of their pockets if they need to answer a question. And that would be the pool model. That's a money market model in which you can model what happens to interest rates if you increase or decrease interest on reserves, if you increase or decrease reserves in the system, and so on. We will see that. And then we have the balance sheet perspective, where we will have a look at the balance sheet of a central bank. I got to know actually during my PhD that even some PhD students weren't quite sure what the balance sheet of a central bank looked like. And I think it's extremely valuable to know that, to understand what is really happening. And then we will have a look at the topics you guys can select, or to be more precise, the students can select for taking my course. I blocked them into 3 different blocks: unconventional monetary policies, which is like something like quantitative easing, forward guidance. Then we have a block in which students can pick a topic on monetary policy normalization. Remember, I designed this course in 2018, 2019, when interest rates were negative or 0, and everyone was thinking about how do we get out of this? Now we got out of this, and central banks actually managed to push up interest rates, even though liquidity is quite high still in the system. How do they do it? There are various ways how you can push up interest rates in an environment with plenty of reserves, and we will have a look at that, or students will have if they want to. And then we have a third block in which students can select a topic of alternative monetary policy frameworks. That is more like thinking about how could we do monetary policy differently than we do it today. One big topic in this area is helicopter money, or average inflation targeting, which was pretty new in 2018 when I designed this course. The Fed adopted it, the ECB did not. So what's the difference between a symmetric inflation target and average inflation targeting? That would be in this block. So what are the course objectives? What I want is the course to be very interactive. It's a seminar. I want students to talk to each other, to learn from each other, not just learn from me. And that has a very simple reason. We just know from research on teaching that it is better if students learn from each other than just learning from a professor, from a lecturer like me. So I want them to interact with each other, learn from each other, question each other. That helps a lot in my view. And participants should learn about the implementation and transmission of monetary policy. That means, so if the central bank decides to increase interest rates to say 2%, how do they achieve this target? How do they do it very practically? How do they push up interest rates to 2%? That would be one part, that would be implementation. And the second part would be transmission. How do they make sure that these 2% actually do what they want to do? It would be reduce inflation. That's mainly the aim if central banks push up interest rates. How do they achieve this final target that they want to reach? And I want to convey the intuition behind all that. It's not that students should be able to solve a complicated mathematical model and then have a result and say, okay, look, here we have this parameter and this parameter. And if we play around with these, then transmission changes like that or like that. No, I want to tell them, I want them to be able to tell a story, what is happening. And then we have the course objectives, and more explicitly, I want them to be able to explain the implementation and transmission of new policy measures like forward guidance, like quantitative easing. I want them to understand the theoretical foundations of the new policy measures. I want them to know why in 2008, Ben Bernanke at the Fed decided to use quantitative easing. I mean, he had some theoretical concept in mind when he decided that that would be a good idea, a good road to go down. And he did. And I want the students to know where these instruments come from. Then I want them to be able to describe the link between the new policy measures and the more traditional ideas. So where are kind of the roots of these ideas? It's kind of related to the theoretical foundations aim here. Here's the more theoretical target that I have in mind. Here's more an intuitive target that I have in mind. And then I want them to be able to evaluate the pros and cons of new policy measures. So at some point, they should be able, say, if they choose this topic, to understand what forward guidance is, but then they should also be able to argue what is good about forward guidance and what is not so good, what is working well, what is not working well. And what I expect from the students, I mean, that's not so relevant for you at home, but I want you to know anyway, in case I'm teaching that course again, maybe next year we will see. I want the participants to participate actively during the course. If they just sit around, I would get mad. Like really, I want them to talk to each other. I want them to read the suggested articles. It's super important that they read what I tell them to read. I'm not giving them like a massive reading list, but if I tell them, okay, look, you decided to work on forward guidance, please read these 2 blog posts and the introduction of this paper, then I really expect them to read them. Then they have to prepare 2 presentations, an intermediary presentation during the semester in which they can ask for feedback from the other students, from me. So they have to prepare that. They have to prepare a final presentation too in the very end. And they have to prepare a discussion, much like scientific conferences do, right? They have someone presenting his or her work, and then a discussant comes on stage and discusses the work of the other person. And that is so super helpful if someone really digs into your work and finds the weaknesses and points them out, right? And they have to do that too. They're grouped, like 2 groups are grouped with each other, and then one group will be the discussant of the other and vice versa. And then they have to write a short essay at the end of the semester. We will see if we're doing that this semester. That's still up to be decided. So the work in progress, I wrote kind of a, I guess we can say a massive syllabus. That's just the work I put into that course during my PhD, where I outlined everything, right? Like the motivation, the literature students can use, the work in progress, the objectives of the course. You can read everything in the syllabus. It's 15 pages long. And here is a work in progress. And what you can see is we're in opening session 1 now. This is up here, where I will say a few words about the course objectives, about the work in progress. Then I will clarify questions about these topics, and I will give an introduction into modern monetary policy making. That will be the pool model and the balance sheet model. And then we have the opening session 2, where I will kind of finish with what I'm doing at the moment. So you will have that condensed kind of in one video, I guess. Then after these 2 sessions, students should be able to make up their minds what they want to work on, because we also in the first and second lecture cover what they can cover during the semester. So we look at forward guidance, we look at quantitative easing, we look at average inflation targeting. I give them a gist, and I hope that I can awake their interest in one of the topics. And then after the 2 sessions, they should be able, or they should just submit a topic to me, tell them, okay, Fabio, I would like to work on average inflation targeting, for example. Then they have to read a little bit, because I will just reply to them, all right, great, you want to work on average inflation targeting. Here's this blog post by Ben Bernanke on temporary price level targets. Make up your mind how that fits to average inflation target, and we'll talk about it. Then we have the intermediary session 1, in which the students mainly talk to each other. So what I want them to do is, prior to this session, they have to submit questions about their own topic. For example, average inflation targeting. They send me a question and say, okay, average inflation targeting kind of implies that you make up with higher inflation after a period of low inflation. Would the opposite be true also? I will not answer these questions. What I will do is I group them with other groups and assign these questions to other groups, and then they join up, and the other group hopefully can answer these questions. That would be the idea. In my experience, what happens is a big discussion evolves out of these questions, and then 2 or 3 or 4 people discuss this one question with each other. And then, of course, I will be around and join the conversation, give some inputs, and then go to the next group, kind of. In the intermediary session 2, we will have a monetary policy expert coming, giving a talk. We will prepare some questions for this person. This year, it will be Sebastian Krenzlin of the Swiss National Bank, of the Money Market Department, if I'm not mistaken, the 3rd department. And he will talk about monetary policy implementation. And that's very interesting at the moment, of course, because liquidity is high, there's plenty of money in the system. Everyone would guess if there is a lot of money in the system, that money would have kind of no price. Interest rates would be 0. But no, interest rates are strictly positive at the moment. How does the SNB achieve that? How does it do it? Then we have homework. Again, students have to come up with a preliminary presentation. That would be the intermediary presentation, kind of the presentation they give during the semester. It's ungraded, and the basic idea here is that they really just lay on the table whatever they know about the topic, and they can make a lot of mistakes. I don't care. It's actually a good thing if they're making mistakes at this preliminary presentation. Then we can correct them, and I mean I can correct them, and the class can correct them too. Then we have bilateral meetings in the time prior to the final presentations, because the final presentation is graded. The final presentation has to be good, and I want the students to have the chance to talk to me before they come up with a final presentation. I want them to be able to pose questions, to discuss open questions with me. And then, of course, we have the final presentations. That will be a fun afternoon. We'll have all the topics covered, and I'm pretty sure it's going to be great. All right, let me talk about the pool model, or the LM model. It's a very old model, 1986, but it's a very powerful model, and it's a model that you can use for current monetary policy making and monetary policy making prior to the great financial crisis of 2007, 2008, 2009. So prior to the great financial crisis, it was pretty simple to do monetary policy. It was it boiled down to increasing or decreasing interest rates with changing the amount of reserves in the system. We will have a look at that in detail. But the basic idea was, whenever inflation is too high, you raise interest rate. If inflation is too low relative to your target, then you lower interest rate. And that would be the prescription out of the Taylor rule. The Taylor rule is a rule that John Taylor came up with in 1993. Came up with is maybe the wrong word. He just kind of discovered the relationship between various variables, in particular the inflation rate, or the deviation of expected inflation from the inflation target, and interest rates. And he realized, okay, if expected inflation this term here, inflation in the next period is greater than your inflation target this term here, that guy here is positive, and that parameter, that's his discovery essentially, was positive and greater than 1 even. So if you had, let's say, make it concrete, an inflation target of 2%, expected inflation of 3%, then you should have nominal interest rates of more than 1% at least. So that would be the idea. And then implementation wise, so that would be the prescription, right? What should I do? Raise interest rates when inflation is too high, when expected inflation is too high. And how do we do it? We do it with changing the money supply. That would be that guy down here. And that's how the model looks. It's really quite simple. On the x-axis we have the monetary base. The monetary base is, in a sense, the money that is in the banking sector. So banks, like we all have bank accounts at commercial banks, right? You have a bank account at UBS, for example. I have a bank account at Credit Suisse. That's our money. And the UBS itself and the Credit Suisse itself, they also have bank accounts. They both have the bank accounts at the Swiss National Bank. And when we measure M0, we kind of measure what the UBS has on its bank account at the Swiss National Bank and what the Credit Suisse has in its bank account at the Swiss National Bank, and so on. We add this up. And then we see how much money banks hold on their bank account at the Swiss National Bank. Let me repeat that. Banks have a bank account at the Swiss National Bank. They have money parked there. It's lying around essentially for just making payments to other banks. And if we add up all the money that is lying around, banks' money at the Swiss National Bank, that would be M0. And then we have the interest rate here. The interest rate is that would be the money market rate, to be very precise. And the money market rate is the rate that banks charge each other for money. So we just said that banks have a lot of money lying around in their bank accounts at the Swiss National Bank, and they can do two things, to be very simple. They can just leave it there and don't think about it, or they can try to lend it to some other bank. And they actually do it. They do it. They did it big time back in 2006, 2007, prior to the great financial crisis. They lend this money to other banks. And of course, if one bank lends, then the other bank is borrowing. So that happened all the time. And if you have lending and borrowing, of course, you have an interest rate at which these transactions happen. And that would be the money market rate. And now what you see is you have a money demand function. This is downward sloping. That's the black line here. To understand the black line here, that's not super trivial. The simplest way to explain it is maybe the following. The interest rate is the price of money, right? If you're short on money, you need money, then you go to someone and ask them, okay, can you give me some money? I need some money. And that other guy will be like, sure, I can give you money. What interest rate are you willing to pay? And that guy would also say, I need at least, say, 5% interest rates if I lend you some money. And he or she would say it's 5% if there's a scarcity of money in the system. If that guy who you want to borrow from is short on money too, then he would charge a lot to give you the money because he's short on money too. He wants to have some money as well, right? And if he has plenty of money, like lots and lots of money, he is really plentiful of money, then you would come and tell him, can you lend me a bit of your money? He would be like, yeah, fine, I can do it. It's not so super expensive. Because if he said it's 5%, I just give you the money for 5%, you would maybe go just to another bank which has plenty of money. And that bank would look at the other guy and say, okay, the other guy charged 5%. You went away from that guy. I will charge you 4%. And I would be like, okay, let's consider 4. And then I look at this guy and say, okay, but you have plenty of money. There must be another bank which has plenty of money as well. And then I look around, right? Then I go to the third bank, and the third bank would maybe see, okay, I turned down 5%, I turned down 4%. That bank looks at its own cash pool it has, and it says, all right, we have plenty of cash. If it's just lying around in the bank accounts at the Swiss National Bank, we get 0%. Let's try to get rid of it. Let's try to lend it to another bank. And we have this bank which is coming in and asking for a loan. And then they say like, all right, I'll give you the money for 1%. And then I take the money, right? And you see, if there's plenty of money around, then banks are willing to lend at a low rate. If there is very little money in the system, if everyone's short on money, and I would go to that second bank, and the second bank would be like, yeah, I'll lend you money, but I'm very short on money too, so I will just give it to you at 5%, not any less. I would go to the third too, and they have very little money. They would also say, yeah, it's 5% or even more. And then the interest rate on the interbank market would be 5%. So you see the logic. If there's a lot of money in the system, the interest rate is very low. If there is very little money in the system, the interest rate is high. And we have an upper and a lower limit. Let's talk about the lower limit first. So we said in the beginning that banks essentially have a choice to do two different things. Either they don't do anything with their money, they just leave it on the bank accounts at the Swiss National Bank, which paid 0% back in 2007, let's say, prior to the great financial crisis, paid 0%, or they lend it to another bank. And now imagine a bank comes and tells you, all right, I want to borrow from you. And you're like, right, fine, I can lend my money to another bank. Would you lend it to minus 0.5%? No, of course not. Because at the Swiss National Bank, you get zero, right? You would not lend it to another bank and make a negative profit on that. You would just lend it at zero or more than zero. That's interesting for you, right? Then you can earn just a little bit. And in the limit, everyone would drive down the price essentially to zero. If everyone is afloat with money, I would go to the first bank and that bank would tell me, you have to pay 0.5. Then I go to the second, that bank tells me 0.4 is fine with me. Then I go to the third, that would say 0.2 is fine with me, because they're all afloat with money. And they earn this wedge if they manage to get into that trade with me, right? So I go to the third bank, everyone's afloat, I pay 0.2%. And if everyone is like super afloat with money, and I have like millions of banks, no, millions is a bit exaggerated, thousands of banks I can go to, then of course interest rates would go down to zero in the limit. And the upper limit, that's a bit more complicated. The upper limit is discount window borrowing. So what you can do at central banks is you can always go to the central bank in the evening, in a sense, and borrow from the central bank. The basic logic here is in the evening you have to have enough money to fulfill the minimum reserve requirements. So what banks have, they have some requirements on how much money they have to have on their bank accounts. The reason is banks have liabilities with us. We have bank accounts at the banks. We can always go to the ATM and cash out our bank accounts. And banks have to be able to pay that. So they have liabilities with us. And to fulfill these liabilities, to always be able to pay out most of the, or some of the clients, they have to hold some reserves. And these reserves, that's the cash they have lying around at their own bank accounts at the Swiss National Bank. All right, and here is the regulation. The regulation says banks have to have a fraction of their liabilities in cash at the Swiss National Bank. All right. So there's some amount of money they have to have in these bank accounts. And now it can happen for some reason, because a big guy went to the ATM at 3 o'clock in the afternoon, pulled out a lot of money, that this cash balance decreased at the Swiss National Bank. The Credit Suisse cash balance decreased at the Swiss National Bank because this guy pulled out a lot of money of his own bank account, and the bank, the Credit Suisse itself, had to pay this cash out, these withdrawals, with its own with its own money it had in its bank account at the Swiss National Bank. All right, so this money is flowing out, and then the Credit Suisse realizes 5 minutes to 5. It is short on this minimum reserve requirement. And then what they can do, they can go to the Swiss National Bank and ask for a discount window loan. It's called differently in Switzerland. I don't remember the name. It's I don't remember. I should know it. In the US, it's called discount window. Anyway, so they can go to the central bank and ask for this discount window loan. And in this case here, the upper limit would be like the interest rate at which the central bank gives money at the discount window is 2.5%. And you see, the money market rate would never go above 2.5%. I mean, why would I go as a Credit Suisse, who is short on money at 5 to 5? Why would I go to the UBS and tell them, look, I'm short on money, would you lend me some? And UBS would be like, sure, I'll lend you some. Here's the interest rate I offer, 4%. Why would I borrow from the UBS? I would never do that. I can go to the Swiss National Bank and get the money for 2.5%. So that's the upper limit. Let me repeat that with the demand function. If there is very limited money in the system, money is very valuable. So everyone is holding on to its money and no one is willing to lend. And they're only willing to lend at high interest rates because everyone is short on it, right? It's like with food. If you have very limited food, if you know you have to be in this class for 2 hours and you just have like one tiny little bar of chocolate, then you would not just give it away to your friend. You would maybe charge him something. If you're a real economist, you would charge him or her something. And if you have plenty of chocolate, you would just give it away, right, for free. And that's exactly the same if there's very limited amount. Let me repeat that. If there's very limited money in the system, everyone holds on to the money and only gives it away to a high price at a high interest rate. If there's plenty of money in the system, then banks are willing to lend at a very low rate. And they're willing to lend down to 0%. So if they can make a tiny little wedge of, let's say, 0.05% on their money, they earn more than 0% at the Swiss National Bank, and they're happy to do it. And they're never willing to borrow at more than 2.5% because banks can always borrow at the central banks at 2.5%. In this example here, 2.5% at the discount window. So that's the demand function of the pool model. But then we have also a supply curve, and the curve is more a line, a vertical line than a curve, because the money supply, the amount of money that banks hold on their balances at the Swiss National Bank is more or less determined by the Swiss National Bank. And the Swiss National Bank can say, okay, the money supply here is about 12.5. And how do they do it? So essentially what the central bank can do always is they can go to banks and tell them, oh, look, you have this, I don't know, this government bond, or you have this stock, or you have this house, it just belongs to you. I want to buy it from you. And the bank will be like, yeah, sure, I can sell my house to the central bank or my government bond to the central bank. It comes up with a price, it offers this price to the central bank, and the central bank agrees or not, let's say, and then they swap these assets, right? The government bond, the house goes to the central bank, and the central bank pays with money. And what happens really is that the balances of the banks at the Swiss National Bank increase, right? That's the mechanism. That's how the money supply increases or decreases. So this money supply just sits somewhere, and the central bank can move it around from left to right, from little to a lot, and that determines where the interbank interest rate is. Remember, this is prior to the great financial crisis, that is 2007. So if the central bank decides to buy a lot of things off the banks, then the money supply is maybe pretty high and interest rates are rather low. And here is what central banks can do if they want to do an expansionary monetary policy. Expansionary monetary policy is a monetary policy which supports inflation in a sense, which pushes up inflation, which stabilizes the economy. That would be happening in a scenario in which expected inflation is lower than the inflation target. Then interest rates would go down. That would be the Taylor rule that prescribes that. Interest rates would go down, and the central bank just sits there, looks at this Taylor rule and realizes, okay, we have to push down interest rates. How do we do it? And this model helps them a lot, right? They just look at this model and they realize, if I want to push down interest rates from 0.75% to 0.25%, what I can do as a central bank is I can increase the money supply. And that's how it works. Well, that's how it worked back to 2007, let's say. To make it very simple, the central bank just bought things off banks. Banks just transferred, let's say, to make it very concrete, a house to the central bank. The central bank paid this house with new reserves, with M0, and that increased the balances of the banks at the Swiss National Bank. The banks just had more cash in their bank accounts, less houses on their balance sheet, but more cash in their bank accounts. It's like with us. If I sell a house, after I sold it, I have more cash in my bank account. And that's exactly the same with banks. If the Credit Suisse sells a house to the central bank, it has more cash on its bank account at the Swiss National Bank, which means that M0 goes up. All right, that was the pool model in about 15 minutes. It was pretty fast. Of course, in the classroom, I will go slower. I will interact with the students. I will like them to stop me. I will group them up in two after I talked about one aspect, let's say the demand curve, and ask them to just discuss it with their peers if they understood what I was saying, 2 minutes or so, and then they can come up with questions. That would be the idea. I don't want to put them on the spot and just be like, okay, you there or you there, do you have a question? That hardly works in my experience. Just pair them up in groups of two, let them talk about what I just heard, and then I can ask this one guy, what did the other guy not understand? So that's usually that's simpler. That gets people more interacting. But here's the second aspect that I want to cover in this first opening session, the balance sheet perspective. Remember, first we talked about the work in progress, the course objectives, and then we went into this block 2, in which I would like to give the students 2 models to work with, and we're in the middle of block 2. We had the pool model. That would be the first model of monetary policy implementation. And here is the balance sheet perspective, which I find very helpful when we think about monetary policy implementation, especially after 2008, yes. So here are the balance sheets of the central bank and the aggregated commercial bank balance sheet, not on the right scale, that's important, but we will change that in a minute. So let's look at that step by step. Let's start on the right. Here's the aggregated commercial bank balance sheet. What's that? So that the commercial bank, that would be a Credit Suisse or the UBS or the ZKB, whatever. And if you aggregate them, you just pretend that there is just one big commercial bank. So just add them up in a sense. That would be the aggregated commercial bank. And the aggregated commercial bank on the right has liabilities, and on the left it has assets. Let's start with the liabilities. Here we have the deposits of firms and households. That's what I was talking about before, right? We all have bank accounts at the bank, at the Credit Suisse, for example. And from the Credit Suisse perspective, it's a liability. Why? Because we can all go to the bank and cash out, right? We can withdraw everything we have at this bank, and the bank has to pay. Like it has to give us like a banknote if we go to the ATM, right? That's why it is a liability for the bank. Our deposits are a liability of the bank. Then we have other liabilities which are not important for this course. And then we have assets. Let me start here with, at the bottom, we have other assets which we do not care about in this course. That could be anything from gold to houses to everything you can think of. And then we have bank lending to the real economy. That would be a loan that a bank gave to a company. Let's say like someone opened up a restaurant, went to the bank and told the bank, okay, I need a credit. I need 10,000 Swiss francs. And the bank was like, sure, let me check your business model. Then they give this restaurant 10,000 Swiss francs. And that's an asset of the bank. Why? Because let's say in 10 years, the restaurant has to pay back this loan, right? That's like the usual setup. You have to pay back a loan at some point, at some future point. And that's why the central bank, not the central bank, the commercial bank can go to this client, to this restaurant and tell them, okay, 10 years over, you have to pay me back. That's why it is an asset. And then we have sight deposits. Sight deposits is M0. There are a couple of words we use there. Reserves is one word, sight deposits is another, M0 is another. So these are all like describing the same. And sight deposits is the bank accounts that banks have at the central bank. So banks just have cash lying around, electronic cash, of course. They have cash lying around too, but they mainly have electronic cash lying around like we have. We have it on our bank accounts at the bank. That would be here. From the bank's perspective, a liability against us. And the banks themselves, they have cash lying around on their own bank accounts. This is here. This is an asset, of course. It's cash, right? They can spend it. It's an asset. And this bank account is at the Swiss National Bank. All right. And then we have the central bank. If we look at the central bank's balance sheet, it's similar in a sense. We have liabilities on the right and we have assets on the left. And if we look at the liabilities, we have other liabilities we don't care about. We have cash that would be banknotes outstanding, not so important for us. But we have the sight deposits here again. And you realize that the assets of the banks, like the liquidity, the reserves, the sight deposits that banks hold at the central banks are, from the central bank's perspective, not an asset. Like for commercial banks, it's an asset, but from the central bank's perspective, it's a liability. Exactly equivalent to that case here, right? Our bank accounts are a liability of the bank. And the bank's bank accounts at the Swiss National Bank are a liability of the Swiss National Bank. So the sight deposits appear here as well. And those of you who are very fast, they see that this guy here should be equally large as this guy here. We will see that in a minute. Well, let's just spend another minute here on the asset side of the central bank. Here we have assets. Central banks have all kinds of assets. In Switzerland, it would be mainly foreign currencies invested in government bonds. Let's say in government bonds, let's say in government bonds in Germany or government bonds in the US or stocks, whatever. They have a lot of assets lying around here. And if we do that in the right scale, you can see it shortens, the central bank balance sheet shortens, and this guy becomes equally large as this guy. And this is not surprising, right? Because all the sight deposits that commercial banks hold at the Swiss National Bank have to appear on the central bank's balance sheet as well. So they're here. So in total, the commercial banks, if we add them up, they hold a lot more assets here, that would be that guy here, than the central bank. Now let's talk about bank lending. So bank lending is something that causes a lot of confusion, mainly because the media reported wrongly or poorly, mostly. Like mostly is too strong of a word, sometimes at least. So what media often say is banks have a lot of money lying around in their bank accounts at the central bank. They could just lend it to the real economy. But that's not how it works. That's not how it works at all. So central banks, commercial banks cannot lend M0. They cannot lend their cash they have in their own bank accounts to the real economy. They can lend that money to other banks, but they cannot lend it to the real economy. And the reason is that the real economy, person like me, person like you, a restaurant, they don't have access to a bank account at the Swiss National Bank. So they cannot just like transfer money to a restaurant and the restaurant has this money then in its bank account at the Swiss National Bank. That doesn't work. So we all have just bank accounts at commercial banks, right? You've never seen a person who has a bank account at the Swiss National Bank, with one exception, people who work at the Swiss National Bank. But that's like 1,000 people in Switzerland. They don't really matter for that part. So when banks lend money to the real economy, if a bank goes and gives a credit to a restaurant, as we discussed just before, then new money is created, so-called M1 is created. And M1, to put it simply, is essentially adding up the balances on my bank account with your balance on your bank account and your balance on your bank account. So that would be the money that we use. We don't add the M0 part. We don't add the cash that banks have lying around. We just add like what the restaurant has in his bank account, her bank account, what this guy has, like this Main Street guy, right? Like every one of us has in their own bank accounts. That would be M1. And M1 is created in the very moment in which banks lend money to the real economy. Let's have a closer look. Oh, that's a bit surprising. I thought that would start with another graph, but anyway. So money creation happens whenever bank lending here to the real economy is getting bigger. So if the Credit Suisse sees that guy from the restaurant and agrees with him or her to send him 10,000 Swiss franc to renovate his restaurant, then the assets of the bank, of the commercial bank, get bigger, right? Because in 10 years they can go to the restaurant and tell this guy, okay, now you have to pay back the money. So this guy is getting bigger, bank lending to the real economy is bigger. And at the same time, this restaurant might have a bank account at the Credit Suisse with 5,000 Swiss francs. And what the Credit Suisse does in the moment in which it lends money to that guy is it tops up the 5,000 Swiss francs to 15,000 Swiss francs. And that increases the liabilities of the banks as well. So what you can see is whenever a bank grants a new loan to the real economy, this guy's here is getting bigger, it just tops up the bank balances of the guy who is getting the loan with the amount of the loan, with the 10,000 Swiss francs. This guy here, sight deposits, is not touched at all. So banks are not lending their sight deposits, their own cash, to the real economy. That's not how it works. And this will be important to know if some of you would like to cover quantitative easing, because quantitative easing decreases the sight deposits of the banks a lot, which does not necessarily mean that a lot of more money is circulating in the real economy. So that's very important. News outlets often said, okay, the monetary base, M0 reserves are exploding, that must be inflationary. And a simple counter argument would be, no, sight deposits increase, but they're kind of stuck in the banking system. It's not going out necessarily to the real economy. It's not changing necessarily M1. It's not changing the amount of money that we have in our pockets. And as long as the amount of money that we guys have in our pockets is not exploding, then it should not be inflationary that banks have more money. So that would be just like a preview of why this is important to know. All right, let me now talk about the topics you can work on during the semester, the topics on which the students can work on, of course, just to give you a flavor of that. We have 3 blocks that I covered in the very beginning. Unconventional monetary policies, that would be a block in which students can choose a topic. Then we have a second block, monetary policy normalization. We will look at that later. And then we have a third block, alternative monetary policy schemes. We will look at that later as well. Let's look at the first block, unconventional monetary policies. There's a lot you can choose from. There's quantitative easing, there's negative interest rate policies, there's forward guidance, there's dual interest rate policies and exchange rate pegs. And I want to go through them just to give you a gist of what this really is, to awaken your interest ideally, and then you can choose after this session, after the second opening session actually, what you would like to work on. So quantitative easing is essentially central banks buying up all kinds of stuff from banks, increasing the amounts of M0 in the banking system, increasing the reserves of banks, increasing the sight deposits that banks hold at the central bank by buying up things, mostly government bonds. the aim is to reduce long-term interest rates. So the idea is that if you have a government bond, which is like a 10-year government bond that has a certain yield, it's called. The yield is kind of what you earn on this bond. If you buy it now, hold it until the end, what you earn on this bond. Now, if you have a lot of people who buy this bond, then the price of this bond is going up, and the price, let's say, goes from 95 to 98 because everyone wants to buy this bond. The central bank is coming on the market, wants to buy this bond. Price goes up, and then you have something then you go on the market, you see you want to buy a government bond as well. You see it's 98 now, not 95 anymore. You buy it for 98, and in 10 years you get back 100 because that's like just the value of the bond. And then you see you make less of a profit on that. And the profit, that's the yield, that's the interest rate on government bonds. I think you covered that in the finance course. It's just the inverse. The price of a bond is the inverse of the yield of a bond. And if you have a lot of people buying up the bond, the price of the bond is going up, the yield is going down. That's the basic idea of quantitative easing. Central bank coming on the market, buying long-term bonds with the idea of pushing up the price of the bond, which decreases the yield of the bond. Here we have a graph which is until 2020. I'm a bit surprised. I updated most of them. This apparently not, but it's not too bad. I mean, it gives you the idea of what happened. This is central bank balance sheet in percent of GDP, and it went up like crazy in 2008. It has never stopped since, right? It's really shooting up. And what you can see here is that the balance sheets of the central banks are getting bigger and bigger. And if we go back to our balance sheet model, if you think of this balance sheet model we had before, then you can see that the asset side of the central bank's balance sheet is going up because it's buying a lot of government bonds. And also the liability side of the central bank's balance sheet is going up because it has more liabilities. Why does it have more liabilities? Because the cash on the bank accounts of the commercial banks at the central banks increased too, right? Because the commercial banks, they sold the government bonds to the central banks, and the central bank paid with newly created money. Like it's just lying around in the bank accounts of the banks now. So this has really been going up like crazy. It stands at more than 100% of the GDP at the moment in many countries. If we look at quantitative easing through the lens of the pool model, what happened is the central banks pushed up the money supply like crazy. Like they were sitting here, and then they started to buy government bonds like crazy, and they took these assets, paid with new dollars, and the dollars are now lying around in the bank accounts of the banks at the central bank, which means that there's a lot of money in the banking system. M0 is going up like crazy, and that pushed interest rate to the lower bound. Whatever the lower bound was, let's dig into that later. But the lower bound in Switzerland was for a very long time 0, because reserves in Switzerland paid a 0 interest rate in 2008. In the US, they have always paid 0% until 2015, the end of 2015. So in the US, the Fed pushed up the money supply because it bought a lot of assets, and that pushed down interest rate to 0. That's exactly what happened. So here's the balance sheet perspective that I alluded to just a minute ago. Central banks are buying up a lot of stuff. This stuff here, to be precise. And for the commercial bank, this just means less houses, more cash. We will see that here. Duck. Here we have government bonds that go here. And the central bank is buying these government bonds with cash. They just top up the balances of the commercial banks at the central bank. They just top them up with the amount they paid. And here we have the sight deposits also, of course, that increase. Hoppala. So for the commercial bank, it means they have less government bonds in their portfolio, but more cash. Duck. More cash, the orange part. Here I prepared some questions, and here the idea is that I cannot do on YouTube, but here the idea is to do in class, to just like throw these questions into the class, pair the students up in various groups, in varying groups actually, just to get them talking to each other. And then I would just like give them 5 or 10 minutes to pick 1 or 2 questions which are interesting for them, discuss them with their peers. So what happens to bond prices when central banks buy bonds? I explained it now, of course, but I was pretty fast. And then they have the chance to go over that again, and I will be around and help them out. Negative interest rate policy, well, it's characterized by negative interest rate targets. It's pretty straightforward, and we had that too. Central banks pushed down the interest rate targets into negative territory in Switzerland to minus 0.75%. It was kind of the world record negative that we had. In Japan, we had negative. In the Eurozone, we had negative. So that's a reality too. If we look at that through the lens of the pool model, it gets a little complicated because it shifts the lower bound here. It shifts the lower bound. And why does it shift the lower bound? Because central banks, what they actually do when they implement negative interest rates is they say, all right, you banks out there, you have a bank account with us. We have always been paying 0 interest rate on that. Now we charge you something. We pay, in quotation marks, we pay a negative interest rate. That essentially means banks have to pay for their bank balances. Let's look at this graphically. If we move the lower bound, if we suddenly start to pay quotation mark minus 0.75% on reserves, it looks like this. Then the lower bound goes to minus 0.75% and the demand curve shifts accordingly. It just shifts down by 0.75 percentage points. Usually what central banks do is they adjust the discount window rate also by the same amount. They reduce it by 0.75% such that the move in the demand curve is kind of like parallel in a sense. But that's not too important here because we're out here anyway, right? We started off with pushing the money supply out here. Then we were at this point at 0, and then central bank decided they want to lower even further, and they lowered further by reducing the lower bound, by starting to pay quotation mark minus 0.75% on bank balances. Here again, I prepared some questions which I find interesting. Students can interact with these questions based on these questions. Then we have forward guidance, describes explicit central bank communication about future monetary policy. I personally find that super interesting. I wrote a paper about this. I spent like half of my PhD working on forward guidance about central bank credibility, about commitment, about limited commitment, and so on. It's very, very interesting. And it started off, like, central bank had used forward guidance prior to 2013, but 2013 was very explicit. The Fed essentially said they won't increase interest rates until the unemployment rate is at least below 6.5%. So that was pretty state contingent, we would say. Like they really said, we're waiting until this is happening. Before you should not expect anything to be happening on the interest rate front. Then we have dual interest rate policies. That is interesting because the ECB used that. What they did essentially was they lent money to banks at a rate that was lower than the deposit rate, which means that banks could go to the ECB and let's make an example in the positive territory. It's much simpler to understand. They did it in a negative territory, but in the positive territory, it's simpler to understand. The central bank offered the banks a loan at say 0.5%. The banks could take out money from the ECB, pay 0.5% for that, and then invest that money kind of like just put it on their bank accounts at the ECB, let it there, they could just lie around and get 0.75% on this money from the ECB. So you see you're making a wedge of 0.25% just by taking the money from the ECB at 0.5 and invest it at the ECB at 0.75. You make a profit out of that. The ECB did that. It's kind of a transfer of central bank profits to commercial bank. It's kind of a subsidy. It's a very, very unique, it's a very special monetary policy instrument. A little bit complicated, maybe not so powerful. It's hard to judge. It's more like an instrument that was used to stabilize the euro area, in my view. But still, I think if you're a good student, it's certainly worth working on that because it's an instrument that was used, that will be used again, pretty sure. Very early in 2020, during the lockdowns, I started a vlog on monetary policy instruments. Pretty crappy audio quality, pretty crappy video quality. But anyway, the content is good. And this is the video in which I describe the TLTROs, the targeted longer-term refinancing operation of the ECB. Here I have that from a balance sheet perspective as well. So the basic idea is that the central bank makes a loan. That would be an asset, right? Like for commercial banks, we discussed that making a loan is an asset. For the central bank, it's an asset too. So you have You make a loan to a bank, tell the bank you have to pay it back in 2 years. It's an asset for you as a central bank, fine. The commercial banks get the money, but they have to pay it back in 2 or 3 years, which means it's a liability to them. And what do they get? They get sight deposit, right? They just get cash. They get cash in. So they're taking out the loan. They know they have to pay it back. That's why it appears on the liability side. But they get an asset too. They get the cash from the central bank. That's the sight deposits. So that's how TLTROs look like from a balance sheet perspective. And here you can actually see why it is so important to understand the balance sheet of commercial banks and central banks, because it helps you understand dual interest rate policies, for example. You understand where the profit comes from, because you can see here the bank has to pay 0.5% to the ECB in our example, and here it gets 0.75% from the ECB, and you have a wedge, you have a higher interest rate return on the assets than you have to pay on the liabilities, and that's where the profit comes from these TLTRO operations. Here also, you know the drill already. I prepared some questions. The student will interact with them. Then we have exchange rate pegs. Here I want to go a bit quicker. Exchange rate pegs, just like essentially saying the euro-Swiss franc exchange rate is 120 and only 120. Then we have variations of that. We have exchange rate floors, which is like kind of one-sided. It cannot go below 120, but it can go above 120. So there's a lot of things you can consider here. And what I realized when I taught this course last time in 2021 in Neuchâtel is that some students, they came, like I had one student from Morocco, I think, and he told me, if I remember correctly, that they had the opposite, they had an exchange rate ceiling. And that is way more complicated to defend than an exchange rate floor, and you can go into details here. But for the Swiss case, the relevant case would be the exchange rate floor, in which the Swiss National Bank, Philipp Hildebrand here, decided 120, that's it, that's the limit, cannot go below that. Otherwise, it would be too strong. That's the exchange rate against the euro, sorry for not introducing that from 2000 to 2020. And that was the time of the exchange rate floor. Questions again on this. And then we have monetary policy tightening. Here we are in the second block. What we've discussed so far in the third block was what can students work on? Block 1, Block A, unconventional monetary policies like QE, like forward guidance, like negative interest rate policies. Now it's the second block of topics students can work on: monetary policy tightening, exit strategy, monetary policy normalization. That's essentially what is happening at the moment. So what central banks can do is they can reduce their balance sheet, they can outright sell what they have on their balance sheets, and banks pay them with the money they have on their bank accounts. They can pay interest on reserves, they can issue central bank debt securities, or they can use reverse repo agreements. And the interesting thing here is the Swiss National Bank is using all of these four simultaneously. Balance sheet reductions are the reverse of QE. The Fed did it in 2018. They started to reduce the balance sheet. They didn't really sell assets as far as I know, but they let them expire in a sense. But you can think of selling as well. It doesn't really matter. It doesn't change too much. So essentially, they just sold their assets on their balance sheets. And if you look at that from a balance sheet perspective, I don't have that here, unfortunately. That would just be the opposite of QE, right? The assets of the central bank go down. The sight deposits of commercial banks go down as well. Why is that? Because commercial banks have to buy back the assets of the central bank and pay it with their cash on their bank accounts, which they hold at the central bank, right? And that reduces the balances on these accounts. It's exactly the same like for you and me. If I buy stuff, then I have less money on my bank accounts. And with balance sheet reductions, the central bank sells stuff to the banks buy stuff from the central bank, which means they end up with less money in their bank accounts at the central bank. M0 is going down. Here are some questions. Again, then we have interest on reserves. Interest on reserves are the inverse of negative interest rate policies. That will be, again, like moving around the floor kind of in the LM model. Let's see if we have that here. Yes, we have it. So essentially, you say we had always been paying 0% on our reserves. Now we start paying 1%. Why not? I mean, you can do that. As a central bank, you can always decide to pay the banks 1% on their reserves. That's how it would look like in a pool model. Remember, we started off with the black line, and then we're down here because we did QE. The central bank bought a lot of stuff. The banking system is afloat with money. M0 is very high. Interest rates are stuck at 0. And now the central bank wants to increase interest rates without reducing the balance sheet, without reducing M0. And it's possible, it can do it. It can just shift the lower bound of the demand curve around by paying interest on reserves. It just decides to pay 0.25% on interest rates. And the fun thing is here now, on the money market, that will be the new money market rate. Why? Because commercial banks now look at what they get at the central bank, right? They see, okay, if I let my money just lie around at the central bank, I get 0.25%. And if another bank comes and is like, okay, could you lend me some money? I would make the calculation. I would say, sure, I can lend you money, but I will never do it for less than 0.25% because I can get 0.25% at the central bank, right? And that pushes up the lower limit on the money market rate. So that's interest on reserves, works pretty decently. Then we have liquidity absorbing operations. Let's focus on central bank debt securities to make it a bit quicker. That would be kind of a government debt that the central bank offers to banks, right? It kind of tells them, look, here's a paper. It pays 2%, let's say 2%. You can have it for 5 years, and you have to pay it with your M0, with your bank balances at the Swiss National Bank in this case. And that's how it works. They used it in 2010, 2011. They are using it again now. And here's the balance sheet perspective on that. So essentially, that's just the central bank. The central bank has a lot of sight deposits outstanding. It wants to reduce the sight deposit. It wants to reduce M0 in circulation in the banking sector, but it doesn't want to sell assets. How can it do it? It can go to the banks and tell them, okay, here's another liability of us, of the Swiss National Bank. It's a paper which says, give me money now and you will get back money in 5 years or so. And that money is that the paper is called central bank debt security. The banks are willing to buy this debt securities because they pay a positive interest rate usually, and they pay it with sight deposits. That's why sight deposits go down. And that would just be like a view on interest on reserves from a balance sheet perspective. You don't like change sight deposits into central bank debt securities. You just leave it as sight deposits. You still call it sight deposits. You just pay a positive interest rate on it. And then we have a block C in which students can choose a topic from. We had unconventional monetary policies, we had exit strategies, and then we have alternative monetary policy frameworks. Here we can work on various things. Like I'm really open to what students want to work on. I have some suggestions. Average inflation targeting is kind of an alternative monetary policy framework. The Fed adopted it. It is working with that model. So other central banks are not, like the ECB does not have an average inflation target. It has a symmetric inflation targeting. The Swiss National Bank is different, again, because they have like a target range, not a point target. Then students can work on permanent or temporary price level targeting. That is different from inflation targeting, right? Inflation, you target how much prices can change. With a level target, you target where prices should be. That's very different. And then we have nominal GDP targeting, or something that is it's often discussed during crisis, helicopter money. What's that? Is it useful? Is it dangerous? We can discuss all that. Here, I just want to give you like a very brief introduction. The basic idea of average inflation targeting is to say, okay, let's not just look at inflation that we expect for next year. Let's look at what happened in the last couple of years. And if inflation had been too low for too many years now, let's say it had been 1% instead of 2% for 2 years, then you say, okay, we let inflation go to 3% instead of just the inflation target of 2%. We let it overshoot to compensate for the shortfalls we had in the previous years. That's the basic idea of average inflation targeting. If it works, then the average of the inflation rate should be exactly the inflation target over time. And that's what Jay Powell, the president of the Fed, announced in August 2020. I remember quite clearly I was in Marzili. I was taking a swim in the Aare in Bern, and I watched it there, and I was super excited that they adopted it. I thought it was a super good idea. It was very well founded in science that they adopted it. Turned out might not have been such a good idea, or they should have clarified one or two aspects of it prior to this inflation episode. Now, there's a lot to discuss. Like, this is really a hot topic, I would say. Here we have just a mathematical representation of what I just told you. Like in symmetric inflation targeting, like the European Central Bank is doing, the central bank minimizes the difference of the inflation, this guy here, from inflation target, just as if it is below or above. We just want to make it as small as possible, bring inflation as close as possible to the inflation target. And with average inflation targeting, the central bank takes an average of inflation over the last 5 years or so and says, okay, we want to push that average of the last 5 years closer to the target. And that implies, of course, if inflation has been too low for too long, you have to overshoot to push the average up. Then we have permanent and temporary price level targeting. That is a blog post that I liked a lot, the temporary price level targeting, an alternative framework for monetary policy. Essentially, I think you could argue that a temporary price level targeting is the same as the flexible average inflation targeting that the Fed adopted, because the average inflation targeting that I just spoke about a minute ago is asymmetric. That I didn't say you before. I'm telling you now, it's asymmetric, and the asymmetry in this average inflation targeting, or to be more precise, the flexible average inflation targeting of the Fed, is precisely that it is kind of temporary. It only allows for inflation overshoots, but not for inflation undershoots, and that is pretty similar to a temporary price level target. If you are interested in that, you can work on that. That's also a very fascinating topic. And then we have nominal GDP targeting. I don't want to go too much into detail here. None of the students worked on this when I taught this course last time. I think it's an interesting topic, but not so trivial. I would say it's maybe the most complicated one in this block C. Helicopter money is a money financed fiscal stimulus. That's really a gift of the central bank to the government. They just print new money and they just give it to the government. That's it. They can spend it. That's helicopter money. If they're just buying government bonds, people argue that's helicopter money too, because governments would have lower interest rate costs of refinancing their activities, and maybe, but in my view, it's really like the defining feature is it has to be a gift, like a permanent gift. Like you print money, and then you're like sitting in front of a lot of banknotes, and you just like take a truck, drive it to the government, and then forget about it. That's helicopter money from my perspective. And you can do a lot of interesting things with that. Like, is it inflationary? When is it inflationary? Under which circumstances? Also a very nice topic. So let me conclude here. That was the introduction to the opening session 1 and 2, kind of like the short version of it. No interaction, obviously, because we're on YouTube here, but with the students we will have a lot of interactions. We stand maybe at around 1 hour and 15. That means that we have around 1 hour and 15 to interact with each other during the first 2 sessions, which is great. That's exactly the aim, what I had. And here are the topics on which students can work on conventional monetary policies, monetary policy tightening, exit strategies, and alternative monetary policy frameworks. I think it's an absolutely great course. I'm really looking forward to teaching it in Neuchâtel, to working with the students. From my experience last time, they really had a lot of fun making a lot of discussions with their peers, discussing topics with me, learning from each other. So it's going to be great. Thank you for tuning in, and see you next time.